All right, let's talk about something that's, well, kind of running the world of modern finance. We're talking about everything from giant billion-dollar hedge funds all the way down to your own retirement account. It's a field called financial econometries. Now I know it sounds super complex, but at its heart, it's this really fascinating quest to find patterns, to find some kind of meaning in the completely chaotic world of financial markets. So, let's dive in.
And this quote, it just perfectly captures the revolution that kicked this whole thing off. You see, for the longest time, finance was dominated by the old boys network. It was all about who you knew. But then something started to shift. All of a sudden, it didn't matter so much who your golf buddy was. What mattered was what you knew, and specifically, how good you were with math, statistics, and computers. The quants, as they're called, had finally arrived.
So what is this science, exactly? Well, think of financial econometries as the special toolkit that people use to test big financial ideas with actual real-world data. It's about looking at the crazy, up and down, dizzying movements of the stock market and asking, is there a method to this madness? Can we actually build a model for the relationship between taking a risk and getting a reward?
But you have to ask, right? Where did all this come from? A field this powerful doesn't just appear out of thin air. It was actually born from a kind of perfect storm, a few massive forces that all came together and completely changed the world of finance forever. So what were they?
It was really three huge things all happening at once. First, the markets themselves just got way bigger and way more complicated. Second, you had these brilliant minds coming up with groundbreaking new theories about how markets are supposed to work. And third, and this is the real kicker, the computer revolution gave us the horsepower to actually test all those theories. I mean, without powerful, cheap computers, most of modern finance would probably still just be a bunch of abstract ideas collecting dust in academic journals.
Now this is where things get really interesting, because it shows how finance is totally different from a lot of other sciences. See, in most fields, randomness, what they call the error term, it's just a nuisance. It's the noise you try to filter out. But in finance, that randomness is the whole story. The uncertainty, the risk, the volatility, that's the main event. It's the very puzzle that everyone is trying to solve.
So, if you're one of these new financial detectives, where do you even begin your investigation? Well, you start at the very beginning. The first step was just to figure out the basic nature of the data itself. Before you can build some grand theory of everything for the market, you just have to understand the fundamental properties of a single stock return. And that meant tackling some really foundational questions, like do stock prices follow what's called a random walk? You know, where past movements have absolutely zero predictive power for the future. Do markets have fat tails, which is a fancy way of saying that huge crashes or massive booms happen way more often than a typical bell curve would suggest? And that discovery alone is huge. It means that once-in-a-century storm could happen a lot more often than we think. Is volatility a constant thing, or does it shift over time? Just documenting these weird quirks was the absolutely essential first step.
Okay, so once the researchers got a better handle on what the data actually looked like, the next logical step was to try and explain it. And that meant moving beyond just describing what was happening and starting to build economic models that could get at the fundamental relationship between the risk you take on and the return you should, theoretically, expect to get.
And this slide just illustrates the evolution of that thinking perfectly. Early on, you had what are called static models, like the super famous capital asset pricing model, or CAPM. Think of that like a snapshot in time. It asks a simple question. For a single period, what return should a stock give you for its specific level of risk? But later, the field developed dynamic models, and these are more like the full movie. They're way more complex because they try to include how our decisions about saving and spending over our entire lifetimes interact with the market. Now, you shouldn't think for a second that these were just some dry, boring academic exercises. No way. They sparked these incredibly intense, passionate debates. One of the most famous was this variance bounds debate in the 80s. An economist named Robert Shiller basically argued that stock prices seemed to move way too much to be explained by any rational changes in their future dividends. Now, this was a direct shot at the efficient market hypothesis, the core idea that prices reflect all available information. This wasn't just a small disagreement, it called the entire rationality of the market into question. And as this quote shows, it basically split the academic world right down the middle.
But the story doesn't stop with these big, broad market movements. To get the whole picture, researchers realized they had to zoom in, way in. They had to put the very mechanics of how trading actually works under a microscope. And this is the world of what we call market microstructure.
And this was only possible because suddenly we had this fire hose of transaction-level data.
So for the first time, we could ask about the real nitty-gritty of trading. How does the bid-ask spread, that tiny little gap between what buyers are willing to pay and what sellers are willing to accept, how does that affect returns? What's the effect of trades not happening every second, but at random, irregular intervals? And it turns out, this fine structure has a huge impact on everything from the profits of high-frequency traders to the hidden costs in your own stock trades.
So we've looked at the kinds of questions that financial econometricians are asking, but what about the tools they use to find the answers? And maybe more importantly, what are the traps they can fall into along the way? This brings us to the actual methods of the field itself.
And this quote, oh man, this quote sums up one of the single biggest dangers in this entire field: data snooping. I mean, think about it. With literal mountains of financial data to play with, if you search long enough, you're pretty much guaranteed to find some pattern that looks profitable. The whole challenge is figuring out if you found a real, genuine discovery or just a random fluke that you stumbled upon because you ran 1,000 different tests.
When you step back and look at the timeline, the progress has just been incredible. In only about 40 years, the field went from asking pretty simple questions about random walks back in the 60s to developing the foundational CAPM in the 70s, to fighting these huge intellectual battles in the 80s, and then finally to analyzing the market literally tick by tick in the 90s and beyond.
But here's the thing. For all of that amazing progress, financial econometrics is not a solved science, not even close. In fact, some of the questions that sound the simplest are still the absolute hardest ones to answer. So what are some of the great challenges that are still out there?
And this brings us to a truly mind-bending puzzle. It turns out, when you properly account for all the randomness in the market, the statistical proof you need to show that a portfolio manager has real skill and isn't just getting lucky is astonishingly high. Some calculations have suggested you would need more than 500 years of data to be statistically confident. It's a pretty humbling reminder that even with all of our most powerful tools, the quest to truly decode the market's randomness has really only just begun.